Well, good morning, folks. My name is John Needham. Welcome to this new edition of the Danielcode report for Tuesday, the 14th of April. As usual, the charts that accompany this report are available to the right of this video on YouTube or at the Danielcode, www.thedanielcode.com. And if you would go and get those charts, print them out, you'll be able to follow. We've got quite a lot of material to get through today. I want to show you first of all how the TO3 signals that I speak about often can morph into a standard Danielcode reversal and the opportunities to profit from that. And I also want to answer some specific questions from members Danielle and Ben, who've written about questions they have. We'll start, if we could please, straight away onto chart number 1, which is a Forex chart. Both of the charts that we're going to be looking at today are Forex charts. For those of you that don't trade Forex, you should, quite simply because we have 16 pairs at the Danielcode. We get a lot more signals in Forex than in any other market. So whereas we might get one TO3 signal a week in equities or gold, we can expect 4 or 5 a day in Forex. So once you have a statistical or mathematical advantage, the more you trade, the more money you make. Naturally, Forex, because there are so many pairs available, is a very substantial part of that income. So if you're not trading Forex, I suggest you should. All of the information you need to trade it is available free at the Danielcode website. There's trading manuals, videos, tutorials, whatever else you need. Start off with chart 1 today, and that is of Canadian Chief, and it shows the TO3 sell signal from Thursday, which was not elected on Thursday or Friday. In our trading protocols, we require these TO3 signals to be elected within 2 days of them being posted, with the day of posting being day 1. But I've also told you on occasions these signals will morph into something else, and what they morph into is a standard Danielcode blue or red line reversal, all of which is explained in the DC trading manual. This one's a beauty, it's a classic, and when these signals are not elected, they should still be treated as a heads up. They're highly probable signals for reversals, and that's exactly what happened in this cross, that the market had its TO3 sell signal on Thursday. It made a snappy little reversal high right at the Danielcode number, 9476 on Friday, and then elected the TO3 the next day. Straight down 115 points pretty easily in that trade so far. I just caution you with Forex trading, it seems almost as if these things are designed to confuse everyone. Some of them have 2 digits behind the decimal point, some 4, some 5. This is one of the ones that has 5 decimal points, and they're not traded as such, they're traded as 4 decimal points. So wherever you see a market with 5 decimal points, just round it down to 4. So you'll see there that that was a fairly straightforward trade, worth about some part of $1,150 per one contract. You'll see both the stochastics were very overbought, right at Danielcode resistance, and the third day after a TO3 signal. Chart number 2 is the Euro USD trade from Friday. It's exactly the same thing we're showing you there. We had the TO3 buy signal on Thursday, was not elected. Friday made a typical Danielcode reversal right at the red line, 1.3097. You bought the high of that bar, Friday's bar, you bought the high of that on Monday. The high was 131.89, so remember we have to allow 5 or 6 ticks buffer for Forex charts because there's no central registry, and the daily highs and lows vary between platforms and between chart data providers. We don't want to be buying what we think is a high and finish up that we bought into an inside day, so we allow that buffer. So you bought that market on Monday at 131.95. You made 172 ticks into the close with pretty easy stuff. Chart number 3, you'll recall that with these signals, if your indicators support them, you can anticipate them on either a 720-minute chart or a 240-minute chart. Chart number 3 is the Euro USD. I'm showing you exactly the same setup I've shown you in the past. The red rectangle shows the time period when the daily TO3 buy signal was current. You can see the stochastic oscillating along the bottom. Remember, for minute charts we only use the fast stochastic, so we've got the 533 stochastic on. The chart with the blue, the bar with the blue rectangle around it is the first bar that gives a positive cross. So you need to buy the high of that plus 2 ticks. We only need 2 ticks allowance for our buffer on the shorter term minute chart. So you bought that at 1.3152 and that was 40 ticks better than we bought it on the daily chart. So you can see the benefit for those of you that are full-time traders or have the time to trade the smaller time frames. The 240 and the 720 minute are very, very good. Make sure that you get the first cross on the stochastic, which is what we're interested in. For Danielle, the question is, where do you put your stop loss? Well, the simple answer is above or below the most recent high on the swing chart. Now, the swings are created from daily charts primarily. The only valid support and resistance, apart from the Danielcode numbers that I have ever found, are daily highs and daily lows. So the safe place, if you're buying this market, Danielle, you put your stop a couple of ticks below Friday's low. The important thing to remember here is there's no such thing in trading as big stops and little stops. You adjust the size of your position, the number of your contracts, so that regardless of the size of the stop, by varying the number of the contracts, it comes out to 1 or 2 or 3% of your bank, whatever your risk management plan allows. I usually work on 2 to 3%. You should start at 1% at least and work your way up. So your stop goes above or under the latest swing, and you adjust the number of contracts to make sure you comply with your risk management plan. The next chart, chart number 4, this is the addressing the question from Danielle, where do these markets go to, what's your exit target, and also from Bob, how do you put the retracements on the chart? Well, the retracements are always drawn backwards. All your charting platforms will have a retracement tool, and in this case you drag the retracement tool from the latest low, that would be Friday's low, and you'll see I've marked with the red lines that there are 2 separate swings in this movement. There's a major swing up around early April, and then there's the minor swing made 5 days ago. Both of those swings are valid for retracements. In this case, as I nearly always do, I've drawn the retracement to the first swing we come across, and in this case you'll see that the 62.5% retracement gave you 1.3397, and that's exactly where the market went to on Monday at least. The 3 retracements that you should be using are 37.5%, 50% and 62.5%. They are valid retracements from the Danielcode. They are not the best retracements to use. We have much better ones than that, which I show you at the Danielcode, but they are the most common ones, and you will, see those numbers being hit all the time. So where do you get out? Well, 37.5% on a daily chart is a very common retracement. 50% is even more common. The basic model I use, these suggestions of where these markets go to, are not terribly reliable. The key thing is to get your stop loss to break even as soon as possible, and then protect profits, take profits as you go. If you can't do that, if you only have one contract, use a trailing stop about 40 ticks from the market. Chart number 5, moving on, is the 240-minute chart of the Canadian chief trade. It's exactly the same as I've shown you on the daily. This time, however, I show you the 240-minute chart. Same deal. You can see the bar that's in the blue rectangle is the first negative cross on the 533 stochastic, and you sell the low of that at 9416, and that's about 18 ticks better than we got in on the daily chart. Where did it go? Well, it bounced through the 37.5% retracement, which is on there. That is certainly a place at which you'd be tightening your stops. Chart number 6 for Ben. I'm showing you here the various swings there are on the chart. Now, you can use, most charting software has a swing indicator. You should be able to get your program to put the swings on these charts if you can't see them. They're actually quite clear if you just look with your eye. And on this chart, chart number 6, there are in fact 3 swings. I've numbered them 1, 2 and 3 and put the red lines to them. They are swings off the daily chart. They are all valid. Chart number 7, I put the retracements, just the standard ones I'm talking to you about today, the 37, the 50 and the 62.5, on all 3 of those swings, and you can see them there quite clearly on chart number 7. You can also see how the first place that Monday's bar went to was a point where we had a 37.5% swing retracement from one swing and a 62.5% retracement from another swing. In other words, we had 2 degrees of Daniel support at that particular point. Some very good traders actually teach that as a technique. I've found on back testing it's not valid, but certainly it's something to bear in mind. Have at the top of your list, but at all times keep moving your stops. Protecting profits, the name of the game is making money, and once you've got profits in hand, make sure you put them in your bank, or at least a good part of them.